And someone in the front raised their hand and said, well, I got about $5,000 I'd like to invest. Could I do that in the preferred equity? And me and my partner, John, we looked at each other and we're like, well, that's not really how we're structuring this. If it does well, maybe you'd get 15%. If it doesn't do so well, maybe you'd get 3 or 4%.
Right.
And then somebody in the back of the room raised their hand and they said, well, actually, I would like to just do the preferred equity too. Can I do that? And it was kind of a light bulb moment.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Jamison Manwaring is the co-founder, managing partner, and CEO of Neighborhood Ventures. Jamison, welcome to the show.
Hey, thanks for having me. Good to be here.
Absolutely, Jamison. The pleasure is mine. There are 3 questions I ask every guest who comes to the show. In 90 seconds or less, can you tell me where did you start, where are you now, and how did you get there?
Started at Goldman Sachs, equity analyst. So I covered software, and that's when I started investing in real estate. I bought a building on the side that my dad's a real estate broker. He found a good first deal for me, 10-unit building, multifamily building. Needed a lot of work, but I wanted the experiment and I wanted to see if I liked it. So did that for my first project. And where we're at now is we've launched a company about 5 years ago. A real estate developer is my partner. He's the real estate guy. I'm the finance guy. We've done 15 projects so far. And then we also launched our fund, our REIT, earlier this year.
That is a lot of moving pieces. I want to get into the history of some of that. At what point in time did you decide to go out on your own and do your own thing?
Yeah, so I worked at Wall Street out of college. I wanted to be a trader on the trading floor at a big investment bank. I did that. Didn't like it. I did it for quite a while. Ended up transitioning within the bank to a little bit of a different role that was more research and valuation and really looking at companies and seeing what they were worth. But I don't like the roller coaster of equities. And I covered stocks that one day they would report earnings and they were up 30%. Next quarter, they're down 40% when they report earnings. And it was just up and down. So our clients at that bank were large institutions, pension funds, mutual funds. They're more used to that volatility, but for me personally, it did not match my temperament. And I started saving some money and was looking for a piece of real estate. I knew I wanted to own something I could see and touch. So when I'm working at Goldman Sachs, my dad found me this building near my hometown that was 2,000 miles away from New York where I was working, but I ended up buying it. And that's really what gave me the first start. I mean, it took 6 months to get it up and running. So it made no money for a while, but I viewed it as more of a learning experience. And then, the money started coming in, the checks started coming in and paying all the expenses. That was the first thing, paying the mortgage. And then beyond that, started generating some cash flow for myself.
That's really cool. I love that. And then when did you launch Neighborhood Ventures? Because it sounds like you've been pretty busy here in the last few years.
Yeah, so that was what got my feet wet, and I knew I liked it, but I stayed in the investment side, corporate investment side for about another 3 years. I moved to a company in Arizona, LifeLock, and I had worked on their IPO when I was in New York. And I ran their investor relations. I had got to know the founder there, and I was ready to get out of New York. So they offered me a job to run their investor relations. And then about 18 months later, we got bought out, and I had the opportunity to kind of decide what would be next. And having that first experience that I really enjoyed, I like seeing kind of the transformation about a building that needed work, but I could see the potential. And I guess I'm just one of those people that I enjoy seeing something come to life that you see it, you see the potential, you make it happen. After I had done that, and then my company got bought out, I really wanted to do something I wanted to do more of those projects. And I knew I would need to start raising capital. And I met a guy who's now my business partner, and both of us were really intrigued around crowdfunding. We thought it could be a great way to bring in more people who have never been able to invest in apartments before, that aren't wealthy. People who were like ourselves and the families we grew up in, where we didn't have a lot, but we worked hard and tried to save some. And with crowdfunding, it really opens it up to everybody. You could start with a few $1,000s and invest it in projects and follow those projects all the way through. So we launched the company in 2017, and we've done 15 crowdfunding projects so far.
That crowdfunding is, I mean, not many people, I think, in the larger transaction commercial real estate space, they're not willing to go there. Not willing to go there, both from just, I think, the lack of understanding of completely how it works, and then also just from a complexity standpoint. And also, I mean, what's your guys' minimum? What's your minimum investment?
We were thinking about maybe we do 10,000, maybe 5,000. We ended up settling at 1,000. So we have a lot of people who just invested the minimum. On one of our projects, we have like 400 investors. So I can totally understand why someone would shy away from that, because it's kind of a whole different business when you have that many investors.
Right.
You have to really take care of them. We've made a big investment in our own software platform to manage all of that.
Right.
And after we did our first project, I thought, this is not going to work. Why would we do this? It took us 6 months to raise $500,000. And we identified our first project, and we thought, okay, let's use this as kind of our beta test, and let's see if there's a market here for smaller investors to raise $500,000. So we thought maybe that would be 50 people or 100 people. And it took us at 3 months in, we had raised 200,000. And we thought, okay, this is going to be really difficult, because the seller was getting antsy. They wanted us to close. We were friends with the seller, so he said he'd give us a few months. But at that point, he said, you can raise this money a lot easier. Why are you doing it this way?
Right.
And my co-founder and I, we set a rule. We said, we're not going to call our friends and fund this. We wanted to really see if we could do it with new, smaller investors. And so we wanted to see if there was a market here. And we ended up having to restructure our offering. Initially we were going to do a waterfall. I don't know if some of the listeners and yourself, I'm sure you're familiar with waterfalls, how they work with preferred equity, and then you get upside, and they're very confusing to the average person. And that's what we found. Sure. And after we tried to do that for 3 months and couldn't get any traction, we were actually sitting in a meeting with a bunch of potential investors. And we had one larger investor who had said that they would fund, a couple $100,000 with a 10% preferred equity, and they would get preferred equity. And what preferred equity means is you get paid first. So It's a lower risk, because the preferred equity holder gets that money before everyone else. After that, it's the next thing that gets paid. And we said we had a big investor who was going to do that. And then we're trying to explain to this group of, it's about 100 people, that after that person got paid, now then if the project did this, they might get this return. If it did this, get this return, all in this waterfall. And we're looking out, and someone in the front raised their hand and said, well, I got about $5,000 I'd like to invest. Could I do that in the preferred equity? And me and my partner, John, we looked at each other and we're like, well, that's not really how we're structuring this. If it does well, maybe you'd get 15%. If it doesn't do so well, maybe you'd get 3 or 4%.
Right.
And then somebody in the back of the room raised their hand and they said, well, actually, I would like to just do the preferred equity too. Can I do that? And it was kind of a light bulb moment where we looked at each other and said, well, let us get back to you, because we'd had a hard time raising our capital at that point. Yeah. So we ended up going and restructuring it and paying a 12% preferred return to our investors. Once we restructured it, we ended up selling it out in about a month. We raised $500,000, And now the 14 projects we've done since then, all of our investors receive a 12% preferred return. And then if we can achieve more than that, then that's where our profit comes in. They're capped at 12%, but they're very comfortable with that. They're happy to get their 12% return.
That's it. There's 12%. You get 12%. Now it's preferred, not guaranteed, but
Yeah.
So it's a 12% preferred return. And after that, they're done.
And it's simple.
Yeah.
Because our investors don't do this. They're working their day job. We have firemen, we have doctors, we have school teachers, and they want to start putting some money away so they can just know 12% makes more sense and it's a good return. And they get a lot of it along the way. As we start generating cash flow, they start getting that, 5-6% a year. And then the other portion of the other 6% that they aren't getting, they get paid at the end when we sell. So they accrue that. And our projects are 2 or 3 years each, and then they get a big payout at the end. We've had 6 of them go full cycle, and then the investors come back and reinvest. But yeah, that preferred really changed the game for us. But it was a slog. Anytime you're trying to have somebody write a check, whether it's $1,000 or $100,000 or $1 million, it's a process. You're not. And for us, we have to do that with 200 or 300 times with each investment, but it's gotten a lot easier now. We're starting to get some momentum behind it because we have a track record. But there was a lot of times where I said that, yeah, there's a lot easier ways to do this.
There are. Hearing your story of a 6-month slog to a $500,000 raise, boy, that's painful. But I think, obviously you knew this, you're on to something. You said you just had to figure out how to make it work. I didn't ever hear any all right, we're going to throw in the towel and just quit.
We knew going in that we're really doing the first one to learn.
Yeah.
And we had a long-term view. If you're hustling and you got to make a lot of money on this first deal, it makes it tough. It adds a lot of stress. So we just had a long-term view. We said, we want to see if there's a market here. The second deal we did 2 or 3 months later, it took us 2 months to raise $600,000 because a lot of those investors had gone through the educational process and now they invested. Right. Our last deal we just launched 3 weeks ago, we hit our target raise in 10 hours.
Right.
And now we have a base of investors that we're growing, who continue to come back and invest with us. And now we can kind of see the beauty of the business model.
Right. And that's just a encouragement, I think, to anybody that's out there raising capital, especially newer sponsors raising capital, and just how difficult it can be in the beginning, like getting that momentum. It is, like you said, you sold out in 10 hours. Like that's a very different experience than let's raise $500,000 in 6 months.
Yeah. And it takes seeing a few deals go full cycle. Yeah. It is you got to have a long-term view. You have to have some patience, some delayed gratification. Mm-hmm. But doing what you say, and investors have a great experience with it, and they get to know you. They want to keep doing it and coming back. So it is that's the barrier to entry in the business, is that first 4 or 5 deals in the first several years to get it going. But there is light at the tunnel as you get through it.
Right. I like also the way you simplified things, that you said it's very confusing for the average investor, the waterfall. I get it at this point because I've seen enough of the deals, but we've moved even to a model like that in our syndications where it's a preferred, and we're still not giving just a straight 12% or whatever it is. We're still doing a split, but it is a base split. It's like, here's the number and we're splitting this and we're done. And there's just no more okay, if then that statements that we're working through on a series of 5 pages long. I mean, I literally saw a deal deck came to me. The split profiles were like 3 pages of, if we hit 18, then by that, and if X happens, then I was just like, this is like,
and as an investor, because I was an investor before I started doing it on the side, I was starting to look at deals and I couldn't even calculate it. And I'm a Goldman Sachs equity analyst, calculating all kinds of crazy stuff. And I was like, boy, how can I really get confidence around what my return's going to be?
Yeah.
because it was so complicated.
Right. Oh man. And the confused mind says no, right?
Right. That's the default. If I can't understand this, then it's a no.
Then it's a no. Then it's a no. Tell me this. You mentioned software, managing this many investors for a smaller sum of money. How does that become cost effective?
Yeah, it's you'll find out quick if you get over, I don't know, 20 investors that you have to get off of Excel and whatever you're doing at your desktop software to manage that, and you have to figure out a better way to work with them. And most investors, it adds some credibility too if they can log into something and see what it all looks like.
Yep.
So we initially used a software as a service, a kind of out of the box software, the white label.
Yep.
And then we were able to put our name on it, and that cost us a couple grand a month. And then we realized that got us off the ground, and that's great because it wasn't a big investment for us.
Right.
And there's those platforms out there. This one was called Crowd Engine because we were doing crowdfunding, but there's others for sponsors that might have more like 30 to 100 investors, or that can work real well. Juniper Square, I think, is another one. But I think that's an important thing today is allowing people to log in to see what they do. And then last year we ended up building out our own platform, which was a significant investment. And now we have a full-time programmer on our staff to manage it and to keep pushing it. But that's our business model. We're a part tech company because we're crowdfunding. We do a ton of marketing. We do a ton of content because we got to talk to a lot of people. We got to keep broadening our audience. We want to hit 100,000 investors in 5 years. So we're growing that way. And so we've put a lot of resources behind it. So it's a little different than the traditional syndicator, but I do think that software is important.
Yeah, no, absolutely. Absolutely. It sounds like you have a penchant for I'm not going to say difficult things, but figuring out going places that most people probably just don't want to go. I mean, does that kind of get you going where it's like, okay, this is really complicated. I got to figure out how to do it.
You're reading, me too well, and my business partner. It's the same way. Sometimes it gets us in trouble. It's like, we should have just done the easy way. But you do learn a lot through the hard way. Right? And then you can default, you can say, okay, that wasn't worth it.
Right.
But, it does make it kind of fun. And we actually, when we started the business, both he and I, we didn't need to start the business. We could have done other things, but we wanted to go try something new. We want to do something novel, unique. And that's kind of driven everything else we've done because we're not afraid to we're not shy at jumping into something that seems difficult. If no one else is doing it, it might be an opportunity. And that's kind of how we've approached it.
I would imagine you mentioned the marketing side of crowdfunding. I mean, there's got to be a robust plan and budget probably in place if you're thinking about crowdfunding, which I am not. But if any listeners are thinking about this, I'm just guessing here. Maybe you can fill in the blanks because I've never done it. But a robust marketing plan and then marketing budget in order to launch a crowdfunding investment. Yeah.
If I don't know if anyone's heard or you've heard about stories on Kickstarter where they have a new invention they're gonna put on Kickstarter, and that was really what crowdfunding came from. And you think the old adage, if you build it, they will come. If I put this new widget on Kickstarter, all of a sudden everyone's gonna flood the gates and invest. And the reality is that you have to do a ton of marketing behind that. And if you're going to if you need to get 100 investors at 5,000 each, you have to talk to several thousand people that actually listen to you and go through the whole thing. You can't, I'm not just saying put an ad out on Facebook or Instagram or something, but you really have to engage several thousand people.
Wow.
to get that many investors, whether that's Kickstarter and a widget or whether it's a real estate project. And one platform I would recommend is Small Change. It's a company out of Pittsburgh, but they're basically Kickstarter for real estate projects. So you could put a project on there. You don't have to have the software. They have all of it.
Right.
They charge a fee, 6%, something like that of what you raise, but you can put it on there, and they work with the SEC, their Reg CF platform, and you can put your offering there. But the problem is, once it's there, they do have an audience, several thousand people who follow them, but you basically have to do a lot of the heavy lifting to get people there and invest. But I think it's a great place to start. Smallchange.co is their website. And then you have to decide, okay, how are we going to market this? How are we going to find people to invest in it and get creative about how to do that? And you have to be a marketer on that side of it.
Right. Yeah. And that's the other half of this business. And I love the way you've partnered up there with your apartment developer side of the business that handles that. And I think that's an often overlooked aspect, is that, this is a lot of what we do is marketing. I mean, this podcast is marketing. It really is. And it's just the part of it that's oftentimes overlooked, as we in real estate want to be real estate people buying apartment complexes. Well, half of the business is marketing. So
yeah. And because there's a lot to that business in and of itself.
Yeah.
I mean, you gotta be good at a lot of things here. For me, I know I'm not that good at multiple things.
Right.
So I have a business partner who's really the construction guy, the real estate guy. Our property managers report to him. Our construction crew reports to him. He finds our deals. And then he says, I don't really want to talk to investors. You got that.
Right.
And, he's not looking at the month-end books to send out to investors. I'm doing all of that. So we've split that up because there's a lot to it. There really is.
There sure is. And we are almost out of time here. I do want to get one, since you love complicated things. You've done crowdfunding. You've built your own back-end portal for all of your now thousands of probably investors on a crowdfunding side of things. You just launched a REIT. Tell me the kind of, in maybe 60 seconds if you can, the thought process behind it, and much like you found with the 12% preferred return to your investors, what was it that was in the market that people were saying, hey, we want a REIT that does X, so you decided to create that? What was that kind of inspiration for that?
As our projects went full cycle and we sold them, we had a lot of investors that said, whoa, why are you selling that building? We really like that location. We would have loved to have stayed in it, but we structured it to be a 2 or 3 year hold period so everyone would get liquidity, including us. So we had to do that for a while, but we realized that we had built up a base of investors that would love to be invested with us more long term. And so now with the launch of the REIT, part of the reason was that we can take some of these projects that we renovate and we reposition, and instead of sell them to a third party, the REIT buys out the equity, almost like it's called an UPREIT. So folks that are in the project can convert and roll their proceeds over to the REIT, and now the REIT holds that project. And we knew that we had a lot of investors who would be interested in doing that because they like our project, they like the returns. And then the second thing for us is it provides a bit more stable business longer term, because now, we're not just doing deals, but we're building a fund. The REIT doesn't have an end date. It's going to work in perpetuity. And so, we collect a management fee on that. And then we give 80% of our upside to the investors. As those assets held in the REIT go up in value, investors get 80% of that, and we're only going to take 20%. So for an investor, that's actually really attractive, that they can invest in stabilized cash flowing assets. And as those things go up in value, they're going to get a good piece of that. So it was kind of the maturation of our business. It just kind of took us to that place where that was the next right thing. And we're doing it as crowdfunding as well. So we're going to need about 10,000 investors in our REIT.
Wow.
And we have 3-4 years to do that. So the REIT will be open, fundraise for that period of time. And it took us about 9 months to create the REIT. We had to work with our legal team, and the SEC had to qualify it before we could launch it. So it was kind of its own thing. When you work with non-accredited investors like we do through crowdfunding, it is much more compliant. Compliance is involved because there's all these protections for those folks so they don't lose their money. If you're working with accredited investors, wealthy investors, it is a lot easier to do a REIT, to do a fund,
Right.
to raise money. But we with the non-accredited folks, there's a lot of compliance involved.
Boy, I can only imagine that there is there. I like the way you're thinking about that. It's almost like an internal recap with the REIT, as opposed to maybe doing an institutional recap on your projects. You're recapping it with your own investor base, which I think is brilliant, because I think on the institutional side, those splits on those recaps are often 90-10. So, I mean, it's kind of it's an even better deal maybe for you guys, but also for your investors, because they already know and like the deals that you're involved in. So it's very, very cool. We are absolutely out of time, which is a disappointment, because I've enjoyed this conversation thoroughly. I've got about 500 more questions for you, but we don't have time for it. Either way, Jamison, if our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Go to our YouTube channel. If you just type in Neighborhood Ventures in YouTube, we put out a lot of content there. Our website is easyneighborhood.ventures. And I'd invite you to follow our content. If you never plan on investing, that's fine. I think you'll learn from what we do. We go do a lot of behind the scenes stuff, and we have fun with it. We also have a podcast, Kiss My Assets. We try to have fun with it. So follow our stuff. We'd love to have anyone follow along.
Awesome. Jamison, thank you so much. Enjoy the rest of your day.
Hey, thanks for having me. It's been fun.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.